if you cannot provide the figures for like your carbon emission, etc., what the banks and insurers will do is that they will try to use the proxy data or industry reference. They will not rank you as like a low risk customer. They will definitely put you as a high risk customers. So the implication is if you really want to get financing, your interest rate will be higher than the others who have lower risks. And the same for your premium as well for your insurance policy.
Hi, everyone. Welcome to the Resilient Supply Chain Podcast. My name is Tom Raftery, and with me on the show today, I have my special guest, Cynthia. Cynthia, welcome to the podcast. Would you like to introduce yourself?
Hi everyone, I'm Cynthia and happy to be here and thank you for inviting me to join the podcast. I'm a banker turned executive coach and board advisor. I spent nearly 20 years in Tier 1 bank, including HSBC, Bank of China, working across different projects involving digital and business transformation. So I'm really happy today here to share my thoughts around what's happening around Scope 3.
And Cynthia, you're the first banker I've had on the podcast. So take it easy on us because, at least in my case, I know very little about finance. But for people hearing you for the first time, how would you describe what you do day to day?
Okay, so I just left banking. Previously,
Hmm.
my key role was to drive different business and digital transformation projects. Just take a simpler example. I drove business transformation for insurance. So what I did back then was to, apart from looking after the business target, like the KPI, the revenue, etc., we also need to look at like the operations, the front end sales management, different kind of things, just to make sure that the business run properly. And at the same time, we need to optimize on an ongoing basis, just to make sure that we can keep abreast of what's happening in the market and the customer preferences.
And what problem are you trying to solve now for organizations?
I spend most of my time solving the people issues because every time you run transformation, you need to take care of the technical part. Can it be digital? Can it be AI, etc.? But the most challenging part is always people. If you cannot convince the people who need to be changed or those who need to support your transformation, you cannot make it.
And from where you sit now, where do you think are organizations getting their ESG initiatives, projects, programs, whatever? Where are they messing up? Where are they going fundamentally wrong?
Recently, because of the economic downturns, a number of companies actually they decrease their expenses on ESG related items. Maybe they just keep the budget to fulfill the regulatory requirement, like writing the ESG report. And a number of companies also find that it's quite difficult to fulfill the requirement because they do not have the data. And we have lots of, say, rumors around how to measure the ESG impact. So if you are like a SME companies, that will be something that kind of an headache to you.
Of course, yeah. And in more complex supply chains, where do you think leaders underestimate most of the risk?
I think maybe because for now, Scope 3 to banks and insurers are not just like fancy things for PR. They are part of the regulatory requirements, no matter it's in Hong Kong, China, Singapore, and also in Europe. So if you're a leader in supply chain, you need to look at it, not just because you would like to have fancy ESG report, because you would like to get financing. And you also
Hmm.
want to get insurance for your operations.
Okay. This is a key topic or a key point, I think. Many people are unaware, I suspect, in supply chain, the importance of this. So, can you explain to people listening the concept of financed emissions and insurance enabled emissions? What are those and why are they important to people in supply chain?
Because for now it's part of the regulatory requirements. Okay, so for the bank, the finance emissions that mean that the bank they cannot just look at their own emissions, okay? They need to look at their loan portfolios. That means they need to check out their customers from the existing portfolio they have to new customers. They need to add those parameters and criteria into their credit scoring mechanism. That's for the banks. And for the insurers, it's kind of the same. They need to look at their own portfolio and they need to assess rather the insured operations they have today can support them to fulfill the requirement. So that actually a number of insurer, they already say no to high risk industry like the coal industry. They do not want to insure them because those customers will kind of ruin their portfolio and they cannot go through the stress test by the regulators.
Okay, so just to kind of put this in plain English, if you want, if I'm a manufacturing company or I'm any company with a supply chain, my scope 1 and my scope 2 emissions are part of the scope 3 emissions of my bank and my insurance company. And my bank and my insurance company have to report as part of their scope 3 reporting my scope 1 and 2. And so if I have a very high scope 1 and 2, the bank that I deal with and the insurance company that I deal with will not look favorably on me. Is that a fair summation of what you're saying?
Yeah, because banks and insurers, they also need to go through like the climate risk pressure test. Okay. So they need to answer questions around, okay, what if the temperature increased by 3 degrees and so will some of your customer go bankrupt? Then will you get default of those loans? Okay. If that's the case, then that should mean financial instability to the bank and even for the wider financial system of the country. So that's kind of something quite significant nowadays.
And these regulations that require the banks and the insurance companies to report their scope 3, it's part of the CSRD in Europe, came into effect, if I remember correctly, in 2024. It's also part of the Californian emissions regulations, which comes into effect, if I remember correctly, start of 2027. And it's in other regions as well. So it's in Europe, it is now, today, an issue. In the US, for people dealing with California, it's about to be an issue. And in Asia, where you're based, it's also an issue today, correct?
Yes, in Asia, like Singapore and Hong Kong, we already have the regulations in place.
Okay. Where else are we talking about? I mean, that's most of the world covered right there, but where else is this an issue?
I think the key challenge is because the banks and the insurers, they are looking at their portfolio so that as a customer or as a lender, okay, or as someone who would like to get your insurance, you need to try to think from the perspective of your bank or your insurer, or else you cannot get the finance you want. Put it very simple, if you cannot get your operation insured, actually you cannot get financing because banks are really
Hmm.
prudent and they love protection.
Yeah, of course, of course. And it's not just lack of insurance potentially, but it's also, I suspect, because it's part of the bank's loan book, banks will try and make the loans less attractive by increasing the interest rates for high emissions projects. Would that be fair?
Yeah. From the bank's perspective, they would like to have kind of a balanced portfolio. So if they find that for now they got quite a lot of risky customer per se, they will try to accept more low risk customer in the future. I think this the implication we can see nowadays.
And it's not just an issue if I have high emissions. It's also an issue if I am not able to properly report my carbon data, because this whole issue of reporting of emissions is relatively immature still, but now it's starting to become more and more vital because banks and insurance companies require it for their own reporting.
Yeah, absolutely. Because as banks and insurers, they need to fulfill the regulation requirement. Definitely, they need figures. Okay. So if you cannot provide the figures for like your carbon emission, etc., what the banks and insurers will do is that they will try to use the proxy data or industry reference. They will not rank you as like a low risk customer. They will definitely put you as a high risk customers. So the implication is if you really want to get financing, your interest rate will be higher than the others who have lower risks. And the same for your premium as well for your insurance policy.
And what do you think changes then when emissions data starts influencing access to capital or insurance?
In fact, even banks and insurers, they need to do business. So they also try to do something to help their customer apart from just driving off them. So banks actually offer different solutions for their customer. They got a full suite of product. For example, they got something called sustainability link loans. If you can link your operation to, say, specific sustainability targets, the bank can offer you more favorable interest rate. And actually, you can see the same from all over the world. For example, Lloyds Bank, they got around £400 million loans to Brookwood Science Tech, financing them on their operation, but they need to link to sophisticated metrics like reducing embodied carbon in new construction. And this is also a type of loan that the bank I work for use a lot with their customer because this is some product that not only applicable to large company, but also applicable to like SMEs as well, provided they can link their operations to specific sustainability targets, for example, from EcoWaters or other service providers.
Okay, so if I am embarking on a project to reduce my emissions, maybe I'm rolling out a fleet of electric vehicles, maybe I'm installing solar panels or something like that, I should have access to lower cost capital.
Yes and no. Okay, it really depends on what you do. Apart from the SLL sustainability linked loans I mentioned, banks actually offer other alternative as well, like financing project that support a company to transit from like less environmental friendly company to one that is more sustainable. So the example you mentioned may be eligible for say different types of financing. So whenever you got this kind of project, the best option is to talk to your relationship managers because they know the bank products really well and they also know your industry and your offering as well. So definitely they can offer you the best solution and maybe they can tailor some solution for you to support your transition.
And as a supply chain leader, if I'm in a company and I'm a supply chain leader, what kind of signals should I look out for from my bank and my insurance company?
If you sense that your approval rate, okay, of your financing solutions or like your insurance policy got lowered, or your bank asked for increased interest rate, or your insurer asked for increased premium, I think it's kind of very clear signal that you need to look around, rather it's because your own problem or because of like the macroeconomics. If it's not about the macroeconomic, that should be something that you would like to do with your portfolio to ensure that you can get the interest rate you wish to have and also the insurance premium that is more affordable.
Okay. Let's make this practical for leaders who are already overwhelmed with lots of other things that are going on. For people who are, for leaders who are drowning in regulation and data requests, what does a sensible 80/20 approach look like?
I think the 80/20 approach can be quite straightforward. I think the leaders can first just look at the data they have to identify the top 20% of supplier that gave out like 80% of the emissions, okay, just rely on what they have. It's not possible to have like the perfect solutions. Maybe you can make use of your procurement spend, or you can call reference to the industry average emission data, etc., just to identify the hotspot suppliers to formulate your own quick heat map. Once you have that, just start a dialogue with the shortlisted critical suppliers. Understand more around what they're doing, and rather they have more data that can help you to estimate the impact. If you can, and if you have connections, you can try to connect them with people that you think can help them to transit. Maybe your bankers who can offer them transition loans so that they can improve their operation, their infrastructure, etc. Or maybe some other your suppliers or customer who are the kind of the upstream or downstream in that industry. They may help them to do their business in a more sustainable way. Once you identify the shortlisted suppliers, or once you have your initial idea around what to do, it will be good to run some pilot so that you can have some verifiable results. Because the key here is that if you would like to get some financing in the future, the bank will, as usual, the banks love ask for different kind of things, right? Long list of supporting. So maybe one of them can be this kind of improvement plan, so that you can show to your banker and ensure that, okay, you are working on something and you got a timeline around that, so that they can also help you to think around how they can help and how they can help you to run your business more sustainably.
And is there any part where the governance adds clarity rather than friction?
I think because for now we got more regulatory requirement for banks and insurers on scope 3. So as compared to previously, we just heard different kind of rumors. For now, you can definitely check out the regulatory requirement. We got AI nowadays, right? So you can simply ask AIs to help you do different kind of summary. Maybe you can ask AI to help you summarize actions or requirements that are relevant to your business, so that you will know as a leader in the supply chain what exactly are the areas that you should look out to, or are the areas that you should talk to your relationship manager or your insurance broker around.
A lot of AI initiatives, though, seem to stall at the organizational level rather than the technical one. Why do you reckon that might be?
It really depends on how we make use of the AI solutions to help. Okay. It really depends on what types of tools your company is using. You can first use it to help analyze your own portfolio, okay, to save some of the works for you. And then you can assess your risk, or you can understand more around your positioning by combining those together with the regulatory requirements or some of the guidelines that the banks and the insurance company they need to comply nowadays. Then you will have like a more data-driven action plan to work on, apart from just your gut feel or what you heard around from like your friends or other practitioners in the industries.
Have you come across any examples of successful uses of AI in this field?
I think from what I heard from my like friends in banks and also customers, all of us are still working on how to best use AI for this. For banks, they already use AI to help predict the risk level of their customer. And definitely ESG is one of the parameters they already feed in those kind of credit risk scoring model. But on the customer side, I guess maybe for now, because a number of customers, they are still believe that ESG is something more related to their reporting than to their financing or insurance portfolio. So maybe they haven't add that into the AI solutions they have right now.
And we've been talking about financed emissions and insurance enabled emissions, but there's another form of emissions called enabled emissions, which we haven't discussed yet. Is this a concept you're familiar with, the concept of enabled emissions? And if so, do you see them becoming an issue for supply chains in the near future?
My focus is more around the finance and insured emission. So I'm not that familiar with the enable emission.
Okay, no worries. So just a quick 101 on enabled emissions. So enabled emissions would be, say, for technology companies, for example, or PR or advertising companies, because they enable companies to create emissions. Maybe a technology company's AI solution, for example, helps a fossil fuel company to extract fossil fuels 20% more efficiently or 20% faster. Suddenly, that enabling of that extra extraction has to be reported as part of enabled emissions. It's not, it's still in the concept phase. It's not a regulation yet, but the financed emissions and the insurance enabled emissions were concepts only a couple of years ago and weren't regulations, and now they are. So enabled emissions are likely to become reporting requirements in the next few years. So I was just checking to see if this was something that was on your radar yet.
Not yet.
Okay. Okay. What capabilities do you think resilient organizations need that they are most underinvesting in today?
I think most of the organizations, they focus quite a lot on the short-term achievement or the hot
Hmm.
topic recently we have. For example, lots of company spend lots of resources on AI. Gen AI, especially in the past few months or in the recent 1, 2 years, maybe next year as well, because it's kind of the hot topic. But I guess the very key questions they should ask is that why they use the Gen AI or what exactly is a business challenge or the customer challenge Gen AI can help them to resolve. That actually relate back to what we discussed around the scope 3 for banks and insurance company. Okay. Because if you are a leader in supply chain, I guess the true reason why should be you would like to have your business run in a more sustainable way. And the byproduct of that is that you can get cheaper financing and you can get your insurance policy easier.
What would you say is one question every board or executive team should be asking themselves right now?
They should ask what is their competitive advantage against their key competitor. The reason why they should
Hmm.
ask around that is that the answer of this question should be the drivers or the basis of all the actions, okay? Because all company, they need to protect or further, say, improve their competitive advantage so that they can continue to grow their customer base as well as their revenue. But for now, I observe that quite a lot of organizations they forgot around their core capability, their competitive advantage, and they just try to do something the others are doing and trying to catch the market.
A little bit of crystal ball gazing. Where do you see all these requirements going in the next 5, 10 years? Do you think they're going to get more relaxed or more strict? Or I suspect more strict, but you tell me what your outlook on the next 5, 10 years for these reporting requirements are.
Yeah, I also think that the requirement will go even stricter in the coming 3 to 5 years, just like the ESG reporting. When we start to have the ESG reporting, actually there's no framework, no benchmark, nothing to reference around. But then we got different guidelines and benchmarking, etc. Okay, I guess that should be the same for the scope 3 or the requirement we talked about just now, especially around this actually affect the stability of the banks and insurance company, which is kind of very important in the entire business cycle. So the requirement will get more stringent because it actually help the banks and the insurance company to manage the potential impact that might be created by climate change and other risks caused by the natural disaster.
And do you foresee a time when this kind of reporting will be required to have the same amount of rigor as financial reporting has today?
I think maybe 3 to 5 years. Yeah,
Hmm.
because for like all new regulation, they will take like 2, 3 years to mature and let practitioner to understand what's happening and to do all the changes. And for most regulatory requirement, there's some kind of grace period, okay, for the practitioner to play around in. So because we are getting the scope 3 related requirements like from last year. So I guess in like 3 years time, all the requirement will become mature and even maybe in US, they will get more requirement around. So by then, everyone need to understand what's happening and to fulfill all the requirements.
Which means that the requirement for transparency in supply chains, particularly the access to real data as opposed to using industry averages, will become more and more important.
Yeah, and at the same time, as more countries implemented the regulatory requirement, customer cannot like move around. Okay, for example, for now, if you really want to escape from like Asia and Europe requirement, you can go for a US bank. Okay, but in the future,
Hmm.
when you cannot run around, you have to fulfill the requirement.
Fair enough. If listeners remember one idea from this conversation, what should it be?
I think they should remember around that 80/20 principle. You just focus on your top 20 suppliers that generate 80% of the impact. Just start from there and talk to your banker, your insurance broker to explore options because you cannot transform your business overnight. Okay, it will take months
Hmm.
and even years to do so. And same for your supplier. So if you do that today and you start the process, next time when your banker asks you, very likely you got a plan, even if you haven't get the outcome yet. And that's already something quite helpful for your interest rate and for your banker to advise you further around what they can do for you.
Cynthia, we're coming towards the end of the podcast now. Is there any question that I didn't ask that you wish I did, or any aspect of this we haven't touched on that you think it's important for people to be aware of?
Yeah, I think you have covered the key areas that the leaders in supply chain need to take a look around.
Okay, great. Cynthia, if people would like to know more about yourself or any of the things we mentioned in the podcast today, where would you have me direct them?
Yeah, sure. They can connect me via LinkedIn. I'm quite active on LinkedIn.
Cynthia, that's been fascinating. Thanks a million for coming on the podcast today.
Thank you very much.